Picture this scenario. You draw perfect support and resistance lines. Your analysis is flawless. Your risk management follows every textbook rule. You place your stop loss at what seems like the ideal location, just below that crucial support level. Then something devastating happens. Price drops like a stone, hits your stop with surgical precision, triggers your exit, and immediately rockets back in your favor. You just became prey in one of the market's most ruthless hunting expeditions. And here's the terrifying truth that most traders never discover until it's too late. This wasn't random market movement. This wasn't bad luck. This was a carefully orchestrated attack designed to extract money from your account and transfer it to institutional players who understand exactly where you place your protective stops. Today we're diving deep into the psychological battlefield that exists beneath every price chart. We're exploring why perfectly drawn technical levels still lead to devastating losses, and more importantly, how you can transform from hunted prey into a skilled predator who profits from these market manipulations. This isn't just another technical analysis video. This is about understanding the dark psychology that drives market behavior and learning to think like the institutional players who consistently extract wealth from emotional retail traders. The market operates like a sophisticated ecosystem where psychological patterns create predictable feeding opportunities. While you're focused on chart patterns and technical setups, professional traders are studying your behavioral patterns, identifying where you'll panic, and positioning themselves to profit from your predictable reactions. The sooner you understand this dynamic, the sooner you can stop funding their operations and start building your own profitable strategy. But before we can hunt, we need to understand what we're actually dealing with. Stop hunts aren't mysterious market anomalies or conspiracy theories. They're systematic liquidity extraction operations based on mathematical certainties about human behavior. When institutional traders need to fill massive positions worth hundreds of millions of dollars, they can't simply hit the buy or sell button like retail traders do with small positions. They need guaranteed liquidity sources, and retail stop losses provide the perfect solution. Think about what happens when thousands of retail traders all learn the same risk management principles. They all place their stops in identical locations, just below support levels, just above resistance zones, at round numbers that feel psychologically significant. This creates massive clusters of guaranteed orders that institutional players can trigger with relatively small price movements. Your individual stop loss might only represent a few $100s, but when multiplied across hundreds of thousands of retail positions, it becomes a liquidity goldmine worth billions. The mathematics are brutally elegant in their simplicity. If 80% of retail traders place stops just below the previous swing low, smart money knows they can trigger enormous selling pressure by pushing price down just a few pips below that level. They don't need to create genuine market-moving news or fundamental shifts. They simply need to engineer enough temporary pressure to breach the obvious level where retail stops are clustered. This is where the predator mindset begins to emerge. Instead of viewing these moves as personal attacks against your trading account, you start recognizing them as predictable market mechanics. Professional traders aren't trying to hurt you individually. They're harvesting the collective behavioral patterns of amateur traders who all learned identical strategies from the same educational sources. Your stop placement isn't wrong from a risk management perspective, but it becomes problematic when it's identical to everyone else's stop placement. The engineering of these hunting operations reveals sophisticated planning that most retail traders never consider. Smart money doesn't randomly decide to hunt stops on any given day. They spend hours, sometimes days, positioning themselves for maximum effectiveness. They analyze order flow data to identify exactly where retail clusters are concentrated. They accumulate positions in the opposite direction of their intended hunt, creating the ammunition needed for their assault. Watch how price behaves around obvious technical levels and you'll start noticing the surgical precision of these operations. Instead of clean bounces off support like textbooks suggest, you'll observe price penetrating just far enough to trigger maximum retail stops before snapping back aggressively. The penetration isn't deep enough to constitute genuine technical breakdown, but it's precise enough to harvest retail liquidity systematically. Professional traders have developed specialized terminology for these moves. They call them stop sweeps because they literally sweep up retail orders in coordinated fashion. The timing follows predictable patterns that create optimal hunting conditions. Low volume periods when fewer genuine market participants are active become prime hunting grounds. Asian session reversals, Sunday night gaps, and pre-market movements offer ideal circumstances because retail traders have limited ability to respond quickly. Volume analysis provides crucial intelligence about the mechanical nature of these operations versus genuine market movements. When price hits your stop and immediately reverses, examine the volume profile carefully. Stop hunts typically show sharp volume spikes at the exact turning point where retail orders were triggered, followed by declining volume as price returns to equilibrium. Genuine breakdowns or breakouts demonstrate sustained volume as real market participants continue trading in the direction of the move. Understanding this distinction transforms how you interpret price action. Those sudden spikes that destroy your positions aren't market manipulation in the conspiracy theory sense. They're the natural result of predictable order flow patterns that professional traders exploit systematically. The faster you accept that your stop placement participates in a larger strategic game, the sooner you can transition from playing defense to playing offense. But knowing where the traps are set represents only half the battle. The psychological transformation from prey to predator requires fundamental shifts in how you perceive market movements, react to price action, and manage your emotional responses. Most retail traders approach the market with a defensive mindset, constantly worried about protecting their capital from loss. This fear-based psychology makes them predictable and exploitable. The prey mentality manifests in several characteristic behaviors. Traders place stops at obvious levels because fear drives them toward conventional wisdom. When everyone else is doing something, it feels safer to follow the crowd. This herding instinct creates the very clusters that institutional players target. Confirmation bias reinforces these patterns as traders seek validation for their analysis from other traders who learned identical methodologies. When stop hunts occur, emotional reactions compound the damage far beyond the initial loss. Frustration leads to revenge trading as traders attempt to recover losses immediately. Fear of missing out drives impulsive entries at the worst possible times. The psychological cycle of loss, anger, and poor decision-making becomes more destructive than the original stop hunt itself. This emotional aftermath is what truly destroys trading accounts. Professional traders understand that retail reactions are more predictable than price movements themselves. They know that triggered stops will be followed by emotional decisions that create additional profit opportunities. While retail traders are recovering from psychological shock, professionals are positioning for the next phase of their operation. The predator mindset requires complete psychological reframing. Instead of reacting to price movements emotionally, you begin anticipating where hunting operations are likely to occur and prepare for what comes afterward. This shift from reactive to predictive thinking changes everything about how you approach the market. You stop taking stop hunts personally and start viewing them as information about where smart money is collecting liquidity. Predators treat stop hunts as liquidity sweeps that signal smart money is clearing weaker positions before initiating real directional moves. Instead of entering positions too early based on technical levels, they wait for confirmation that the sweep has completed and genuine momentum is beginning. This patience separates consistent winners from traders who constantly get caught in false breakouts. The psychological shifts required for predator trading demand disciplined mental conditioning. Patience must replace impulsivity as your default response to market movements. When you see price approaching obvious stop clusters, resist the urge to enter immediately. Wait for the sweep to complete and price action to confirm the reversal before committing capital. Emotional detachment becomes crucial for interpreting stop hunts as market information rather than personal failure. When your position gets stopped out, instead of thinking, "the market punished me," reframe it as, "the market just revealed where liquidity was collected." This perspective shift transforms frustrating losses into valuable intelligence about market structure. Expecting manipulation rather than viewing it as conspiracy theory helps you prepare for market realities. Understanding that liquidity extraction is part of the market's fundamental design prevents emotional shock when it occurs. Professional traders don't fight these mechanics, they adapt their strategies to exploit them. The tactical playbook for predator trading combines psychological discipline with technical awareness. Instead of placing stops at obvious herd levels, identify where retail clusters are concentrated and position yourself to profit from the inevitable sweeps. When price approaches levels where thousands of retail stops are waiting, you're looking at high-probability reversal opportunities. The courage to take opposite sides when retail traders are being forced to exit requires overriding natural risk aversion instincts. Professional traders buy when retail traders are forced to sell and sell when retail traders are forced to buy. This contrarian approach feels uncomfortable initially but becomes profitable once you understand the underlying mechanics. Using retail stop clusters as your actual stop-loss levels creates favorable risk-reward scenarios. If price pushes through the retail stop area and continues moving, you know the move is genuine and can exit quickly with minimal damage. If price reverses from the retail stop area as expected, you can ride the bounce back to fair value with tight risk and substantial profit potential. Mental stops with strict disciplinary rules can reduce vulnerability while maintaining responsible risk management. Instead of placing hard stops at obvious levels, use predetermined exit criteria based on time, price action, or volume patterns. This approach requires greater discipline but prevents automatic execution during liquidity sweeps. Observing volume and price action after sweeps provides confirmation signals before entering positions. Don't place entries before the manipulation occurs. Wait for the sweep to complete and momentum to shift before committing capital. This patience ensures you're trading with the professionals rather than against them. The psychological tools necessary for consistent predator trading require ongoing development and practice. Emotional regulation becomes your primary edge when everyone else is panicking. While retail traders fear sudden price moves against their positions, professionals recognize these moves as artificial manipulation and prepare to fade them. Journaling emotional reactions rather than focusing solely on chart patterns helps identify psychological weaknesses that undermine trading performance. Track your feelings during stop hunts, note your impulses, and develop specific rules for managing these emotional responses. This self-awareness prevents destructive decision-making during high-stress market moments. Setting rules for emotional regulation creates structure during chaotic market conditions. For example, wait a predetermined number of minutes after any stop hunt before evaluating new trade ideas. This cooling-off period prevents revenge trading and allows rational analysis to override emotional impulses. Reframing stops as data points in a larger probabilistic system helps maintain perspective during losing streaks. Every stop represents information about market structure rather than personal failure. Professional traders factor stop losses into their overall strategy rather than treating each one as devastating setback. The predator mindset isn't developed overnight. It requires consistent practice, emotional discipline, and willingness to act when price action looks terrifying. Most traders can't psychologically handle taking positions against violent price movements, which is exactly why stop hunt reversals offer exceptional profit opportunities. Risk management for stop hunt strategies requires different rules than conventional trading approaches. Since you're positioning against momentum, prepare for immediate drawdowns and maintain discipline to hold positions through temporary adverse moves. Professional stop hunt traders often use time-based exits rather than price-based stops, giving their positions room to work while retail panic subsides. Understanding that profitable mean reversion takes time and patience rather than immediate gratification helps manage expectations during position development. The ultimate psychological edge comes from recognizing that you're not trading against the market itself. You're trading against other traders' predictable behavioral patterns. When you stop seeing price movements as random events and start recognizing them as results of human psychology interacting with market mechanics, everything changes. You become a student of mass psychology rather than a victim of price action. Every stop hunt becomes a wealth transfer opportunity from amateur traders who react emotionally to professional traders who understand the game being played. The transformation from prey to predator requires accepting uncomfortable truths about market structure. The market isn't fair. It's not designed to help retail traders succeed. It's a sophisticated system that extracts wealth from predictable participants and transfers it to those who understand the underlying psychological dynamics. But this knowledge creates opportunity rather than despair. Once you understand how the system operates, you can position yourself on the profitable side of these transactions. Instead of funding institutional operations through emotional reactions, you can participate in the wealth extraction process by thinking like the professionals who consistently profit from retail psychology. Volume signatures provide additional confirmation for distinguishing between genuine moves and manipulation. Learn to read the difference between artificial spikes created by stop hunting and sustained volume that indicates genuine market sentiment. This skill helps identify when to fade moves versus when to follow momentum. The tactical application of predator psychology extends beyond individual trades to overall market approach. Start viewing charts as maps of human behavior rather than purely technical constructs. Identify where fear and greed are likely to create predictable reactions. Position yourself to profit from these emotional extremes rather than becoming victim to them. Pattern recognition becomes focused on psychological patterns rather than just price patterns. Learn to identify accumulation phases when smart money is positioning for hunts. Recognize distribution phases when professionals are preparing to trigger retail stops. This behavioral analysis provides earlier entry signals than waiting for technical confirmations. The competitive advantage comes from willingness to act when others are paralyzed by fear or greed. Professional traders understand that the best opportunities occur when market action looks most terrifying to amateur participants. Your comfort with uncomfortable situations creates profit opportunities that most traders can't psychologically access. Risk management psychology must adapt to contrarian positioning. Accept that positioning against momentum requires tolerance for immediate adverse movement. Develop rules for managing these temporary drawdowns without abandoning positions prematurely. Professional traders know that profitable mean reversion requires patience and emotional control. The long-term perspective helps maintain discipline during short-term adversity. Understanding that trading success comes from consistent application of edge rather than perfect individual trades prevents emotional decision-making during temporary setbacks. Each stop hunt becomes part of a larger profitable strategy rather than isolated failure. Building the predator mindset requires constant awareness of your emotional state and reactions. Monitor your feelings during different market conditions. Identify situations where you tend to make impulsive decisions. Develop specific protocols for managing these psychological triggers before they undermine your trading performance. The transformation isn't just about changing trading tactics. It's about fundamentally rewiring your psychological relationship with market uncertainty. Embrace volatility as opportunity rather than threat. View manipulation as information rather than conspiracy. Treat other traders' predictable behavior as edge rather than obstacle. Professional traders succeed because they understand that markets are psychological battlefields where disciplined participants extract wealth from emotional participants. The technical analysis is secondary to psychological analysis. Price patterns matter less than behavioral patterns. Chart formations are less important than understanding the human emotions that create those formations. Your choice is ultimately simple but profound. You can continue being prey, placing stops where everyone else does, reacting emotionally to manipulation, and funding institutional operations through predictable behavior. Or you can learn the rules that govern these psychological dynamics, develop the emotional discipline to act against the crowd, and position yourself to profit from the very manipulations that currently destroy your trading account. The market will continue operating according to these psychological principles regardless of your participation. Institutional players will keep hunting stops because retail traders will keep placing them in predictable locations. Emotional reactions will continue creating profit opportunities for disciplined traders who understand math psychology. The only question is which side of these transactions you want to participate in. Will you keep being the source of liquidity that smart money harvests? Or will you develop the predator mindset that allows you to participate in the harvesting process? The choice determines whether you build wealth through trading or continue transferring your wealth to those who understand the psychological game being played. Remember that mastering stop hunt psychology isn't about avoiding stops entirely. It's about understanding when stops represent genuine risk management versus when they represent predictable behavior that smart money exploits. Professional traders get stopped out regularly, but they factor these losses into their overall edge rather than treating them as personal failures. The journey from prey to predator requires patience, discipline, and willingness to think differently than the majority of market participants. Start by observing stop hunt patterns without immediately trying to trade them. Study volume signatures during suspected manipulation. Track your emotional reactions to different market conditions. Build the psychological foundation before attempting to profit from these dynamics. Which psychological shift resonates most strongly with your current trading challenges? Is it developing the patience to wait for confirmation instead of chasing early entries? Is it building the emotional discipline to act against violent price movements? Or is it cultivating the detachment to view stop hunts as market information rather than personal attacks? Share your thoughts in the comments below and let's continue this conversation about transforming your trading psychology from prey to predator mentality.